Back to B Grade Economics. This is Nate, your class leader. Let's get started. So, I've been busy the past couple days modeling a lot of different market activities and going back through history to try to get a better understanding of where we might be going in the future. And one of the things that I've noticed is that there is a difference in the way that markets respond to corrections and crashes in an inflation-based environment versus a standard or stable monetary base. Um, so what I did is I modeled out the difference in the activity that tends to occur in a market corrective behavior in an economy with a limited supply of money versus market corrective behavior in an asset inflation focused economy with a centrally controlled money supply. So like a central bank capable of injecting liquidity when things become chaotic. And what I ultimately identified was that at first you get a deflation of asset prices in a normal corrective process, and then it finds a bottom, and then eventually a resumption or correction of prices begins. During that crash, people at first sell their assets and they go into money. The government stability at the time causes the government bond prices to rise. The more stability and trust in the system and the bond prices, the higher the price will go, meaning that the bond yield drops, but that yield is better than buying a stock at the time. And so the money, the purchasing power of the currency goes down. So when the purchasing power of the currency goes down, the reason why is because they start buying back into stocks and they start buying bonds more. Basically, the desire for liquidity falls off rather rapidly, and it goes back into more asset-based again. And so this normal recovery does have a timeline, and it may be a slow timeline, but eventually there is a bottom found as long as the market and the government are generally stable. Now, when there is a corrective action in a centrally controlled money supply system, the automatic response of the enterprise is to keep asset prices inflated in order to keep jobs up. This is generally a Keynesian driven ideology where keeping asset prices up and keeping liquidity in the system injected by the state would allow or the central bank would allow an increase in employment so that this way the crash does not cause unemployment. Because of this, something else happens that is a little more chaotic than I think people are willing to admit or realize. And it causes a recovery to inject into the system. But because money or currency was added so heavily into the system, monetary based assets like gold or silver tend to pick up from the bottom there as well. So they crash down, unlike the primary money supply, because it's not the base money that people go to for liquidity. The price of the monetary asset deflates or crashes with the price of stocks at first. It usually doesn't crash as horribly by percentages because it's not as leveraged, but when people are trying to pay off their margin debt or their leverage or to close out their positions, they sell off good assets like gold or silver. Now, once it crashes, it finds a bottom, and because of the inflation injection, they both begin to recover simultaneously. To an extent, sometimes the monetary assets will outperform the stocks. During this crash, the same thing happens into bonds where people flow into bonds. The price of the bonds are bid up, so the earnings on those go down. However, again, money was injected into the system. Inflation of the money supply occurs. And so this causes an anticipation of inflation fears, which spurs both the monetary base to increase and a reduction in the purchasing of bonds. Now, because there's inflation, you would think that the bond price should just go down, but a lot of the ways the inflation is built is by the state purchasing bonds in the first place, so it kind of causes a yield curve control to occur. Not only that, but because of the injection of the liquidity and the inflation fears, there's also a fear that the activity could change and therefore cause destabilization, and it has proven to do so repeatedly. 1970s as an example, 2008, 2009. We keep seeing these events in at least in American market history and European market history that we see the injection of inflation of the money supply causes this cycle to occur where there's an initial drop in both assets, the liquidity is added, both of the speculative assets, the monetary assets and the stocks, and increase in their price occurs, and we begin to see a move out of bonds for a momentary basis, but then the fear doesn't completely belay because the stock prices start to move very rapidly. And they begin to outpace the monetary assets, as the better trade is the directly affected inflationary assets, the stocks. Now, the problem is eventually they head into a bubble, or a policy does change, like they were fearing it when they prepared by continuing to buy bonds, and so the market crashes again anyways, both either in nominal terms or at least in real terms, in terms of a real return after if adjusted for inflation. And so the monetary asset drops with it at first because, again, you end up in the same scenario where people are seeking liquidity, and so they'll sell off their monetary assets as well in order to pay off their margin debt. And then once that debt has been washed out, the monetary assets go up in price because they're based off of a stable, limited supply, and the stocks take a while to recover as they go through this trend of liquidity being moved into monetary assets at first, and then the monetary assets decline and the stocks go up. Meanwhile, the bond's price actually continuously goes down. So every time one of these events occurs, the trust in the bond and the real return of the bond continue to get worse because of inflation. And so eventually you just end up weakening the currency supply that you're using. So I don't think that this system actually adds real stability in terms of when it's applied to a free open market, and that is a huge concern, because this is what we've been told, is that it does create stability, and I'm starting to very much disagree based off the evidence. But it's a way to try and keep asset prices up, even if the real return isn't good. And I guess if you're keeping them nominally up, you at least satiate people. But so just to simplify this rather chaotic chart, I turned it into just simple phases of up and down. So phase one, you have the crisis event, and in the monetary controlled base, you have a fall of stock prices and the precious metals, or the monetary assets, and you have a rise in the bond prices. So people buy bonds and they sell off everything else. In phase two, once the money is injected into the system, or the currency is printed, both of the speculative assets go up and the bond goes down. And the third phase, and if you've been paying attention to most of the macro events occurring, it would make sense that we're approximately in the third phase if you don't think that the American economy today is going to rapidly recover, and everything's going to be all right, and inflation fears are going to begin to belay in a nice smooth transition. Then we're going to repeat history. And so third phase, stocks are going up, monetary assets are going down, because people are selling in preparation for another one of these deflationary events. And bond prices are going up because, again, smart money is preparing for a deflationary event before they go into an inflationary event. And basically it's because the policy change may cause the asset prices to fall. So you'd rather take a losing bet on holding a stable yielding asset than holding dollars themselves. And if you hold the monetary assets like gold or silver, they're going to fall at first. So you'd rather get an opportunity to buy those on that dip if you're expecting it to come, so you sell them off preemptively. And so then you do get that dip, at least historically for the past, well, we saw it in the 1950s, we saw it in the 1970s, we saw it in 2008. So I think we're 3 for 3. I think 3 data points is enough to prove this alone. But in phase 4, the stocks and the monetary asset goes down again, and we repeat phase 1. And then because of the inflation, the bond falls in real value. Now the bond prices might stay up, but it doesn't really matter. The bond's real return goes down. And so then the stock real return goes down. So they may be going up nominally because of inflation, but in terms of what you really can purchase with those, they go down. And the monetary assets go up in their real purchasing power. And then in stage 6, the final stage of this, you get a blow off top in the monetary assets, and then you get a final recovery starting in the stock prices. But ultimately, you've weakened the currency and the value of the bond, so the real return continues to stay low. And making a recovery from here is hard because you continue to set a precedence of the same activity. So I am applying some of my own opinions to this system, but this is what I've observed, and so it's my channel. I'll make my observations and complaints, and you can leave your comments below. So we have the early 2000s, the 2010s, and I'm going to go over one. In 2000, we had the crash of the dot-com bubble, right? And so gold started ticking up, and part of that was because we hit peak gold productivity in 2001. That was the highest we'd ever produced gold. And after that, it's been nothing but a decline all the way up until 2020. So we have had a constant reduction in supply. However, that peak 2001 production was pretty high. So declining from that has been just a slow trend. Now, we had a rally begin on just the bare fundamentals that gold was extremely undervalued by comparison to other assets, and the inflation of the money supply due to borrowing and the rapid expansion of credit in the system throughout the dot-com boom, and then to follow the housing boom, caused gold to continue to increase in nominal price in dollars. So what we have is the bond yield begins to decline, and we have the housing market crash in 2007, and this leads to an actual stock crash as the mortgage-backed securities begin to default. And we have the crash that happens in both gold and the stocks, but the bottom is found faster in gold than it is in the stock market because people begin to seek real yield, but through a speculation of growth rather than bet on the stocks at the time and the losing bond because of the injection of money supply. And sure enough, we had inflation 2008 to 2009. We had high CPI numbers, and so it was very clear to most investors that the way to go is precious metals at the time. Now, obviously, if you think that the economy is going to recover, and I remember going through this, nobody really thought the economy was going to recover for a long time. They kept saying we were in a recession. Honestly, the bottom came in pretty quick in 2009, and you could have just started buying back into that. But the real returns were still higher in the precious metals area, in the monetary assets, before it got to the stocks outperforming it. So you do have a window where you can take advantage of that swing into precious metals much more rapidly than you do in stocks. And then you can take that and you can maximize your wealth by transferring from the precious metals back into the market when you think that the recovery is probable, right? So just to show you on the bonds and how real return really works, a lot of times we say that these are risk-off assets, but history has shown that to not really be the case. You're actually taking a loss in many cases throughout history, especially in high inflation eras. I think the 60-40 portfolio really showed the bias in the 1980s and 90s that that this prosperity was going to continue and this trust in the monetary system was a little too strong. And so people have to be a lot more dynamic today in their portfolio management, which is why I advocate for active management. It can be monthly or quarterly, but you really do need to take real assessments of your assets and where the true economy is going, and not just set it, forget it, because it's not working. And so, yes, if you had bought a 30-year bond in 1980, you were set. You could have just lived off of the dividends from those 1980s 30-year bonds. But today, that's not the case. And so in times of war, we see that the real return drops simply because people pile into them because they're not very faithful of the stock market, and the inflation continues in a wartime environment. We saw in the 1960s and 70s that the real return from both the chaos of Vietnam and the inflation of the money supply really showed us that real returns can go for a very long time in the negative. So just things to think about when you're trying to set up your portfolio to be low risk. Bonds need to have real return projections that are going to actually work out. And so I want to highlight here that in 2008 we were having a steadily increasing gold supply. So 2001 was peak gold supply, and in general we've had a decline. However, when this mania was kicking off from 2008 to 2011, we actually saw that the mining production increased because the price had increased enough that new mines had started up in the early 2000s, and it had continued to higher production. Again, in 2012, we hit a peak, and then we've seen a decline again since then. So overall, we've been on a downtrend, but you can see how price can rise even though supply is being increased because the trading volume eclipses it. So 2011's peak, honestly, was kind of a weak peak because of how much extra supply there was. There was just that much more volume into the market in order to compensate for the lack of yield elsewhere. And so here's just mining supply just to show you how much we've progressed with all the technology and everything. But so far, 2001 really is the peak here. And the financial crisis caused the prices to run up while the supply was generally on the decline. And so it's worth noting that you will have differences in the production versus the pricing. And so energy prices also play into this. But it's just to show you that just because it's a limited supply doesn't mean it isn't increasing or decreasing into the market. And so in the 2008 financial crisis, we saw that the gold price continued to increase as the COMEX gold stockpile increased because miners were selling to the COMEX for personal this was for investment purposes. COMEX Gold is the #1 place for independent investment and for even central banks to purchase through. So you get very large flows of volume of gold ounces through the COMEX. And so supply was increasing. So of course, eventually we had to hit a peak here. And then the eligible and registered began to decline rapidly. And they sold to central banks who were selling their gold onto the market as well during this time, thus increasing the supply. And then they were buying it back off once the prices began to decline or had hit a peak. And just to show you, monetary assets function much like any other market. At first, there's a real functional event that has a mean of value, and the inflation causes the prices to jump. However, we get corrections as people think that the inflation is over or the fears subside. But that final blow off top phase really is filled with a lot of greed and a lot of mania. So a lot of people want to say that something like gold is a sound investment and a sensible decision to buy. But in 1978 to 1980, there were a lot of news reports about theft and greed and how much people didn't like that the price was rising because it was causing problems. Blaming gold, obviously, for that is kind of misplaced because the real problem was the inflation of the money supply. But it just goes to show like how the mania can really kick off, and there can be lines outside the door to purchase gold when realistically at the time it peaked there at $800, it had essentially eclipsed the market cap of all of the dollars in circulation in the 1980s. So it's just kind of something to note that just because you're buying a monetary asset doesn't mean that it won't go through a manic phase, and doesn't mean that it has anything to do with industrialization or any of the underlying value of use. It has really just to do with it being a store of purchasing power, and that's it. This also reflects through in the, I've been working on this model. This is just a quick draft of it, but I'll have something up and do a whole video on it later. And it's just to show the way in which a society goes through inflationary trends, where it has a denial phase where they think that it's going to return to normalcy. But then because the money supply increased so much, the velocity picks up, the real velocity, not the number measured by divided by GDP, because the GDP increases with the inflation, thus canceling out the numbers. So the real velocity begins to increase, and there's a lot of denial, and so only early monetary speculators kind of pick up on this as soon as it occurs. The later adopters are still very early when they do jump on this wagon, and so temporary disinflationary numbers are kind of your first shakeout, and they do occur. The media doesn't really acknowledge it. They're kind of in that denial phase until it's gotten bad enough that the average person in that society, and I'll have a whole bunch of research to back this up to show that, and I put it on my Twitter too, of how different countries have reacted to inflation and how drastic it's gotten before there's any real attempt to disinflate or the government actually responds to it. And so even when they respond, it's usually not as good as what they should have responded to, and the money supply that they're trying to account for really doesn't reflect properly because it's just so massive. They're usually much more muted in their first attempt to fix it. And so you'll usually end into a really high phase where government starts to take control measures to restrict public activity. In 1933, it was gold confiscation. In the 1970s, it was price controls, rent control, and that continued for a while, and it just continued to prove that it's wrong. And today, 10 out of 10 economists will tell you price controls don't work. That's like one of the few things you can get a whole bunch of them to agree on. It doesn't, like, they could be Soviet Union, ex-Soviet Union, and they will say price controls weren't working in our country. Like, it's really impressive how they say that doesn't work, but governments always go to this one, and I'll support it with all the evidence. But governments always go to this one, and so it's kind of worth noting that we're going to see this attempt again to say that their prices need to be controlled somehow, and every economist in the world will be telling you that doesn't work. There will be monetary actors, people who work for banks, the Federal Reserve, things like that, who will say that this can be effective, but it's really just in support of politicians that are pushing it because they essentially work it with a relationship to them. And so it's I promise we're going to hit this phase because historically it happens every time. But I also promise you that it doesn't work. So, but anyways, I just want to end with a review of the Bernanke quote. Central banks have been a great source of moderation, and this shows that a very unnatural set of interest rates for interbank lending. And you can see that the rates peak before each crash as they attempt to disinflate the bubble. If it was a naturally occurring rate, the rates would continuously increase as the demand for borrowing goes up because of the risk increase. And so that would just deflate bubbles a little more naturally. It's not to say that bubbles wouldn't exist in a fractional reserve system or in any speculative system, but the leverage would get more and more expensive and kind of quell itself out, as opposed to having to make drastic jumps that tend to cause the response of a crash. And so it's just to point out that while bubbles are a social response, manipulation into the markets kind of has this effect where you see a change. So these are my hypotheses and theories, but they're based in some pretty sound fundamental work. So I'm not going to sit and act like I'm wrong or trying to make excuses. I just think that there's pretty strong evidence to show that we get an inflationary period that causes a speculative mania into securities, and then the policy changes to try to quell the inflation of the asset prices because they're afraid of a crash that then ends in a crash. And so then they have to lower rates to get us out of so that they can then increase the money supply through lending. And then later they begin quantitative easing in 2008. Where it causes a increase in actual liquidity into the system, which then causes more speculation. And so we just continue to see the cycle repeat, and I think it just works in a wash over time where eventually you have to reset the money supply again. So we went from a gold standard, we went off the gold standard to compensate for our inflation, and now we're off a gold standard. So what do we have to do next to reset? Do we go to MMT, or do we go to some type of gold reserve asset base, or do we reset a currency debt? It doesn't mean that that reset has to happen this cycle, but it's pretty clear that you're running out of gunpowder or gas here to get us down this trail. So just worth noting. But in terms of your future investment goals and interests, you might want to pay attention to how monetary assets respond to inflation and deflationary cycles. And so if we are in phase 3 today, then you would obviously think that, okay, so we're going to go through phase 4, so I should be preparing to purchase or already have some exposure to in case we don't get the nominal crash and we only get a inflationary crash. So anyways, thanks for watching. I hope to see you next time.